Good afternoon, everyone, and welcome to Santander's Global Market Outlook for 2025. My name is Kamran Butt. I'm the Global Chief Investment Officer. And with me today as well is Juan Sanchez, Indian Global Investment Strategy Team. So let's kick off with our thoughts for the year. But before we do that, we look at 2024, and it's been an eventful year, to say the least. We had jargons like high landing and tough landing and inverted yield curve. We also had the mother of all elections in 2024, with 50% of the world population under a voting scheme, all the way from India, all the way from UK, but also landing in the United States of America just lately. But clients that were fully invested were well rewarded. And as we can see in terms of performance, equities being up over 20%. And depending on which sort of bond you're looking at, they were up to about 7 to 7 and 8.5% as well. So investors, despite a lot of disorientation in 2024, were well rewarded being invested. And I think that's really a key message, going forward. Disruption can still yield to performance. And as we can see, as the markets are moving over and looking at 2025, what be it? And we'll see a lot of the same type of trajectory as we saw in 24 moving into 25. And as you can see, growth rates will be very similar. And I think it's sort of the notion of moving to a normalized environment where 2% growth for the US is sort of in line with this long-term average. We all know that corporate balance sheets are absolutely healthy in the US. Default rates are very low. But also US household, they're absolutely cash rich with high saving rates as well. And consumer confidence are at the highest level. So I think we're really moving to this normalized environment where back to sort of the long run trends which we've seen. In terms of monetary policy as well, we all know that rates won't be high for longer. And I think we're now at a point of this sort of global reduction in interest rates. If you look at the G20, barring obviously Japan, but the rate reductions has already kicked off and already started. And again, I think it's a realization that central banks doesn't need to really look to keep rates where they are. And I think that's something that we're going to continue to see over the course of the year. It's not really about how many rates or how much reduction we'll see, but it's a trend in direction which is going to be key. I think that's what's really evident. But also seeing that trend, and that's usually I think dictates the first half. The second half, we may see some volatility. We know that with a new incumbent president in the US, fiscal exuberance, corporate tax reductions, and geopolitical events could provide a bumpy road in the second half of 2025. And I think that's where we really need to be quite nimble and sort of look at how to navigate these particular scenarios. As we've seen, geopolitical events like war are still very evident in the global landscape. And I think that's where we really need to look to navigate really carefully. And I think active investments will be key. Being nimble will be absolutely key. I think 25 for us will be a stock picker's year. Now, those that pick the right selection will be rewarded, whether they're stocks or whether they're bonds as well. Now, in that sort of mindset, picking the right themes will be important. And I think one of the growth secular themes which we see is productivity. And I think this is an early cycle driven by artificial intelligence, that making sure that productivity is not just a phenomenon, but this is a decade to come of real development under the corporate world. And we know artificial is really spearheading that as well. And that's sort of the typical type of winners which we see will be really evident into 2025. That gives you a bit of the backdrop of what we like to see and where we want to really be positioned in terms of a normalized environment, but active investing being absolutely key. Secular growth stories will also be a part of, I think, investors' portfolios. But one day, moving over, how can we really look to capture some of these sort of themes and this backdrop of 2025?
Well, as you mentioned, the economic backdrop that you have described is quite positive for financial markets and could continue to do so. The negative part is a little bit of that has already been discounted. But if we look at this table, and we have summarized the performance of fixed income markets and equity markets in periods where we have this combination of lower rates and economy holding on, which could be described as soft landing, no landing, could have many adjectives, but that type of environment has rewarded investors and has rewarded being invested and not being secure in short-term investment in cash, in liquid position. And this is very important because as a result, in this graph, we can see the correlation of this movement in higher interest rate that we had since 21 until 2024, very recently, with the September rate hike in the US. But that increase in rates has also has made investors look for short-term and liquid position. There's a lot of money. There's over $2 trillion US dollars in increase in money market funds that could begin the search for yield. Because one of the things that we know for sure is with lower rates, there is the rewards of being in short-term rates are going to be lower. And historically, it's been very positive to be invested in the yield curve. You mentioned that we had an anomaly in the interest rates, that there was the yield curve was inverted. There was no risk premium to be positioned in the long term, in longer term. But this graph shows that we are going to have a steep yield curve, a bull steepening, mainly because of a movement in short-term rates, and that is going to provide good returns for fixed income investors on the treasury side. It's not going to be linear. You mentioned that we are going to have a shifting landscape in many areas, and the fiscal concerns that you mentioned, the geopolitical concerns, could provide an environment where active investment is going to be key, but it's also going to be key for the positioning in credit markets. Government bonds, you mentioned that the corporate balance sheets are in very good shape, and credit investment likes moderation. This economic backdrop that you have described is normally good for yields, but you need to diversify because corporate spreads, credit spreads have tightened. And we need to diversify beyond the obvious positioning in corporate bonds. And there are many alternatives. There are many alternatives in leveraged loans, in credit in the financial sector, AT1s, or more specialized areas like emerging market, and especially mortgage-backed. Mortgage-backed have the collateral of the real estate, and the real estate is the fundamentals of real estate have improved as a result of lower rates, and there's very good dynamics in the residential sector, and that's a very good fundamentals for investing in that type of securities. But we need to invest through more specialized fixed income strategies, and with and also strategies that have the possibility of being nimble and doing active positioning as the economic environment begins to change during the year. So that's the recipe for fixed income. It's a generally good environment, but we need to diversify and we need to be active. What about equity markets? This is the picture in terms of valuation. These are the ranges of the earnings multiples in the different geographies, the historical range, and the white dot shows the current valuation of markets. Two different pictures, US and India with a very significant valuation premium, and the rest of the world with a valuation that is very much similar to historical standards. We analyze in the report the US exceptionalisms in terms of valuation. Is It's based on fundamentals. It's based on a more accommodative regulation. It's lower tax rates, higher growth in the economy, and an economy that has been able to attract innovation in a very, very spectacular way. So, but we have to be able to to play these markets that have a very different view in terms of valuation. And a very specific aspect of the current situation in financial market is the exceptional growth of what we call the Magnificent Seven, which are seven technological leaders in the US that have now similar valuation as economies as India or France or UK. So this is something unprecedented in history. And it's a result of the phenomenal growth that we are seeing in artificial intelligence and other innovative areas. What we tell investors in our report is that this exceptional premium based on fundamentals, because as we can see, the earnings growth of these 7 companies have been over 50% in the previous quarters in terms of earnings momentum, while the rest of the economy, there was zero growth in earnings. So that disparity in earnings is what has driven the phenomenal performance of these stocks. We see a convergence in terms of the earnings growth, which is good for diversification and to be able to position in other sectors like financial sector, tech as well, because the drivers for tech momentum continues to be there, but we can diversify in other sectors that also benefit from this macro environment. And a steepening of the yield curve is very good for financials, and also the lower loan, the good credit environment is also another good driver. So we see the opportunity to have good earnings momentum, which is the ultimate driver for performance in equity markets. We think is going to be a broader opportunity. And you mentioned AI as a secular factor. And in the report, we do an analysis of what happened in equity markets with the last disruption that we had, which was internet. So, and we make an anomaly, and we saw that in previous tech disruptions, we have like a wave, like a Gartner innovation wave, in which there was a lot of hype with infrastructure. In the case of internet, it was routers, it was internet providers, it was cable. And then there was a phase of disillusion because the adapters, the users of technology, it took some time to spread through the other sectors of the economy, and then we had the phenomenal growth of e-commerce, streaming, cybersecurity, social media, and now we have a similar pattern in which there is a phenomenal growth in the infrastructure of AI. And what we are telling investors that we need to position for the adopters of AI and robotics and those companies that are going to be able to implement these amazing technologies with new business models that are going to create a lot of value. But so we need to transition a little bit from the infrastructure theme to other things like, for example, data centers or energy, because there's going to be an explosion in the use of data, in the need to create a more important data infrastructure, and that's going to also require huge investment in electrification and in energy production. So this innovation and productivity boom is going to happen, and is going to create many opportunities, and we need to look beyond the obvious of what we have seen in the last quarters. And finally, we describe a lot of opportunities to diversify with other asset classes, and investors need to be aware of the phenomenal growth in private markets. Mm-hmm. The opportunity set of value creation is beyond the opportunity in listed market. And private markets, private credit, infrastructure, private equity, real estate, they are growing and especially institutional investors are positioning in the opportunities in those markets. Those markets are growing in size. And we, in this graph, in the right-hand side, we can see that in this, compared with the tech disruption, there's few IPOs, because most of the opportunity has been played through venture capital and private equity, and there's very little opportunity to invest in these companies like OpenAI or Anthropic or Mistral. These players that are disrupting the market, the private equity is not is still not listing these opportunities in the market. So with this example, we want to highlight the need to also invest part of the portfolios in longer, in long-term vehicles that invest in private markets. So in a nutshell, those are the main ideas that we see for 2025 in this shifting landscape that you have described.
Great, thank you, Juan de. That was very fascinating and interesting. I mean, there's a lot there in terms of opportunities for our clients really going forward in 2025. So let me try to summarize a little bit there as well. 25 for us will be a stock picker's year. A story of two halves. I think the first half will be a risk-on mode. So continuation of the benign environment which we're in at the moment. So that will be really conducive for investing. But the second half, I think there potentially could be pitfalls. Geopolitical risk. We talked about that. A new government in the US. We're talking about sort of potential of that ugly head of inflation maybe coming back, of the fear of that as well. So I think what's really key and important is being active, and being active advisory and the active managed way in terms of your investments and how you look at your portfolios. That's going to be absolutely key. It's difficult to time these markets. I think it's a great on paper, but it's done far and few between. But having a diversified portfolio is absolutely key. But also what's important is an asset allocation framework that really keeps you robust and protected for what I'll call is different scenarios in 2025. Now, as I said, and as we mentioned, the benign environment means that there are also opportunities in terms of these growth stories and secular growth stories. But even in the credit market or the equity markets, opportunities are there. But it's got to be a bottom-up approach, and selection and being really selective is going to be absolutely key for 25. You can't time these markets, but time in the market beats timing the market. I mean, that's a common phrase we like to use in terms of getting the right mindset with clients going forward. What is key, and what I'd like to really summarize, and my last words are, be fully invested at all times. I think that's absolutely key. We've seen in 24 clients being rewarded by being invested, and that will be the same in 25. Cash won't be king in 2025. Thank you.
Thank you.